right, let me go ahead and record. All right, everybody, we're going to go ahead and get started. So if you are not talking, we're going to go ahead and have you put yourself on mute. I don't think we'll be taking an hour today. We'll probably have just a 20-30 minute discussion. But again, we want to make this very interactive. So Vanessa and I are going to talk about what's going on with the real estate market, just so everybody's aware. And then we're just going to do some taxes in your rental property, just as good reminders. And also we'd love to hear if you've got tax tips that have worked for you. Vanessa and I are not tax consultants. We're not legal consultants, but we do by, we learn by doing. And so we always feel like it's really important to share what has worked for us, but also we're totally open to learning. So, and I think most of the people on the call, you've been to some of our meetings. Toilets to Tenants, we started about 4 years ago. And it was just a way, we both had rental properties and we would meet and discuss what worked with tenants. And so we just decided there's a need in Denver. And so we started this group. We used to meet on a regular basis on the first Tuesday. And I'm going to go ahead and I'm going to get everybody on and start muting people if you're not muted. Because I'm starting to see some people not muted. So we started 4 years ago. We have a Facebook page. We were meeting the first Tuesday of the month. And now we've switched to the second Tuesday of the month, and we're just doing these meetings virtually. And again, we just try to share important information that we think people will appreciate. So with that, Vanessa, do you want to go ahead and talk?
Sure. One thing that, when we decided to do this discussion about taxes, many tax advisors have been encouraging people to take the debt off of their primary property and put it on their rental properties so that they do get a write-off from the interest. So that is something to kind of consider, because right now with the standard deduction, many people, the mortgage interest is just kind of a wash that's on your primary property. So the rates, though, have been rising. But I ran a few scenarios just so that I could give you guys some numbers. If you did a refi on your primary with a good amount of equity, it's 3.25%. So we're in the low threes, but the twos we're not seeing anymore. And investment is 3.875, which is still phenomenal. I still have people coming to me with rates at like 5 and 6% for their investment properties, and 3.875 is pretty sweet for an investment property. And then if you were doing a purchase, which Nina will talk about how hard purchases are these days, we have, with 25% down, we have 3.875 on an investment, and the same 3.25 with primary. So they're still in the threes, which is still historically wonderful. But nobody is predicting that they're going to go back to the twos. From all of the mortgage market guides that I subscribe to and watch, they believe the rates are on the rise, and that if you haven't refied, I would not wait. But that's all I kind of have. Any questions for me?
And I was just going to put a plug in for Vanessa. Like if, I know right now some landlords are having tenants that aren't paying and they're kind of struggling with bills. It could be a time to look at refinancing. If you've been able to keep your mortgage payments up, look at refinancing your rental. A lot of people have built equity in their rental. And if you look at doing another 30-year or switching to a 15-year, you could be bringing your payments down and making it where it's more in reach. So I would say reach out privately to Vanessa, maybe just talk about some different scenarios that could work if you feel like you're struggling, or if you're like, I want to get the most tax benefits, so I'd rather put the mortgage payment on my rental versus on my primary. So she's a good person to reach out. So if nobody has questions for Vanessa, okay, I'm going to quickly talk about the real estate market in Denver. So kind of on the right, if you can see, people are asking me what the real estate market is like right now. And I'm like, remember back in May where we ran out of toilet paper and there were long lines? It's like that right now. So we have 58% less inventory right now in February 2021 than we did a year ago. Right now on the market for buyers, there's 2 weeks of inventory. And I'm seeing this in all price range, lower, upper price range. I am surprised the $1.5 million and above is super strong. And what we're seeing is a lot of buyers coming in California, New York, and they're coming into the Denver market and they're like, wow, it's cheap here. And so that's part of what's driving the prices up. What we're seeing is sellers aren't putting their homes on the market because they're worried about COVID. They don't know where they're going to move. They're waiting for the vaccine. So that's one reason our inventory is so low. And then with interest rates, they were at record lows. Buyers that have been waiting have been coming out. And so for the first time ever, condos in the townhome, the average price of a home went above 400,000. So in February, it was 401. And then the single family home market, our average price is 632. So we just continue to see that, buyers, it's brutal out there for buyers, especially first time home buyers. I'm seeing multiple offers. They've now, as soon as a home comes on the market, if I have a buyer interested, I have to get on it right away. Showings are set up in 15-minute increments, so you have 15 minutes to get in a house and then make a decision. And you need to literally put an offer in on that day. So it's really tough for buyers. So anybody looking to invest in the Denver market, it's tough. If you are holding on to a rental that you don't love and you've been thinking about going and investing in another market, now is a great time to put that rental on, and also if you have, something that's in a tough location or a tough layout, and you've always known that, now you're going to get probably the best price for that house that you have. So just kind of something to think about. It is a pretty brutal market. We are seeing, though, this kind of market across the country, probably tougher in Denver market than in some of the other ones. And so that's just something to be aware of. Does anyone have questions on Denver real estate before we get into kind of our tax and investments? And again, we want to make this very interactive. So if I'm talking and you have suggestions or you have something you want to mention, I'd really love, feel free to chime in, and we can make this really interactive. Okay. So we're going to talk about what are some of the things just to remember with taxes. Tax time is coming up. So probably your biggest deduction is the mortgage interest. And right now, mortgage interest on your primary, you may not be able to deduct all of that because of the tax laws that went into place previously. There's a $10,000 limit on state and local taxes on your primary. There is no limit on your rental property. So if you've got, a loan on your rental, you can deduct all of that. And so you just want to make sure that you are taking advantage of that. And again, if you're kind of feeling like, oh, margins are really tight, some of my renters aren't paying, now might be a good time to look at reinvesting and look at getting, a new mortgage on your rental property. And then Vanessa, I don't know, can people deduct some of their closing costs? Do you know if they're refinancing right now on their taxes?
I think they can, but I'm not sure how it's spread out.
Okay.
So I think that when you get your settlement statement, your closing disclosure, you should give it to your tax preparer. I don't prepare my own taxes, so I just always give it along with my mortgage interest statements. because I do believe there's portions, it's a fee associated with your property. So, yeah.
But I know for sure if you're paying down points to get a lower interest rate, you can't deduct that. So there's certain things that you can't. My husband does our taxes and we use Turbo Tenant or TurboTax, the premier version. So if anybody has been doing their own, it's a great product and they actually walk you through all of the different things that you need to do with your rental and have you refinanced, have you purchased it new this year? So that's just something to kind of think about. And then you can, if you're taking credit card debt or doing some other loans, some of that can be tax deductible too, but there's certain laws and limitations to that. So you just need to be aware of that. Okay. The next one is local travel. So anytime you go to your rental, anytime you go to the hardware store, if you have to go to the bank, and a lot of times if you have a local rental, it's not going to be a lot of miles, but it does add up and, it's something to keep track of. I actually just have a spreadsheet that says where I went, how far it was and what I was doing there. So that's the key to this is keeping good records. There's great apps as well that, you literally can say, start the app. When you get to your destination, you can say stop. And then you can type in why you were going to that rental property. Was it to talk to a tenant or to meet a contractor? So there's two different ways of doing deductions for this. One is the standard mileage, and probably most landlords are going to do this. And that's just based on your actual mileage. So in 2020, it's 57.5 cents per mile. In 2021, that's actually decreasing, and that's because the price of gas is low and it's decreasing to 50 cents per mile. So you just kind of track that and then you multiply it by that number and that's your deduction. The other method, and that is what we call actual expenses. So that's where you look into your lease payments, your auto insurance, your gas, your maintenance. So let's say you have a vehicle and you're using it a lot for business. What you have to do is you have to claim a certain percentage for business, a certain percentage for personal. And then you look at those expenses and let's say you use it 50% for business, 50% for leisure. You would add all those expenses and then you could take half, depending on what your business to pleasure ratio is. So that's another method. And I would say that works best for people that use their car for like Uber drivers. If you're a property manager and you're going to tons of properties, if you're a real estate agent, that's probably where the actual expense is going to work out. And you can actually each year, as long as you've done standard mileage for the first year, you can then switch the next year after. You can say, oh, this year I've got a lot of expenses and it makes sense to do actual expenses versus standard mileage. So you can kind of switch back and forth. And then Vanessa, I see a chat come by. Do you want to be the person to kind of review chat window? I think somebody was doing a chat.
I can't see the chat.
Okay, let me see if I can see.
I mean, I see the chat icon.
All right, so Debbie says she uses Miles IQ tracks your miles without you having to remember to start and stop it. You can put in the address of places you go and it will track for you. So as long as you don't mind admitting that Google knows where you are. And pretty much Google knows where we all are. So I've heard of Miles IQ and I'm going to write that down as one. And then I know there's a cost associated with it. I don't know if it's a one-time fee or if it's a monthly fee. So thanks, Debbie. Okay, so that's local mileage. We also have some people that travel. And so especially if you've got a mountain property or you've got that rental property in Florida, you can do some of your travel miles. If you're going specifically, oh, I'm turning it over, I've got a new tenant coming in, I'm going to do some maintenance. You can deduct your airfare, your mileage to get there, food and hotel. You have to be really, really careful. And again, this is where you want to read the rules Because if you start staying in that place and using it for vacation, that could get you into some trouble. So you want to, really document this well and make sure you're taking it, if you're doing it part leisure, part business, make sure you've got the right ratio on what you're trying to do. So again, the IRS, this is one of those things that could get you flagged with the long distance travel. So just use it wisely. Okay, legal and professional services are deductible. So if you're paying for attorneys, accountants, property management companies, real estate investment advisors, real estate agents, any of these fees, are part of your operating expenses, and then you can deduct them. So that's just something to remember. If you use TurboTax, keep the cost of what are all the fees that I have to pay for that. Or if you have an attorney or tax accountant, so have them give you a receipt or an invoice. Okay, operating expenses. So, anything that you need to use to manage your business. Do you pay monthly for a website? Do you have brochures? Have you paid for photography or for a floor plan? Or a lot of landlords right now are doing video. So you can keep the cost of that, and that's all part of your operating expenses. If you're paying for background checks for potential tenants, any bank fees. I know if you are a real estate agent, the Department of Regulatory Affairs are requiring that all real estate agents put their money for any security deposit into a trust or escrow account. And that just went into effect last year. So that's a new requirement. And they're also requiring that all of our leases are reviewed by a lawyer. So again, those are some additional fees that you want to just kind of keep track of. Utilities for the property, if you have a lawn maintenance company, if you're paying for gas and water, and then your homeowner's insurance for the property as well. So those are just some of the things to make sure you're keeping track of. Okay, repairs and maintenance. And this is where it gets a little bit tricky. So there's a difference between a repair and an improvement to the property. So repair is anything that you're doing just to maintain the current condition. And, this is things like unclogging a shower drain, patching a hole in the wall, repairing the sprinkler system. So they're generally smaller ticket items. They're not big ticket items. And so what you could do is you can deduct that all in 1 year. And so, keep good records. And we'll talk about this a little bit later, but if you are paying somebody that is a small business owner, like the plumber who has an LLC, you do need to provide them with a 1099. And we'll talk about that a little bit later on what the requirements for that are. So again, keep track of the repairs that can all be deducted in 1 year. Then there's something called capital improvements. So major improvements to your rental property. If you are replacing all of the hardwood floors or putting in all new carpet, there is a deduction for that. And, for instance, if you're putting in new appliances, you can do a depreciation over 5 years. And so each capital improvement may have a different depreciation schedule. And that just means that you can't deduct that all in 1 year. So if I spend $5,000 on new appliances this year, I can't deduct that all this year. I have to depreciate it over 5 years. So appliances are 5. I think fencing and sidewalks are 15. Roofs, additions, things like that are 27.5 years. So there's all different periods. And again, your accountant or TurboTax is kind of ask you that, like, oh, did you do an improvement? And what was the improvement? Okay, this is how you can deduct it. The other thing to keep aware of is you can actually deduct the actual, so you have a rental house, you can deduct the rental house over 27.5 years. You can't deduct the value of the land. So the value of the land, land will always be land, but the value of the house can change, and so can the value of the land. So you're going to take the rental house and you're going to deduct that over 27.5 years. And everybody's going to do that deduction, because the reason is when you do go to sell it, even if you didn't take that deduction, the IRS is going to say, I don't care, you should have been taking it. And so you're going to have to pay back some of that depreciation. So that's just something to be aware of, that the government kind of expects you to take that depreciation. And so you will have to pay that back unless you're doing a 1031 exchange. So yeah, those are just some of the capital improvements. Again, keep really good records and receipts for anything that you do. Okay, tenant costs and services. So a lot of times I'll have people say, hey, I got this great tenant and they're handyman, or they know how to do tile. And so one of the things they do is they're like, I'm giving them a discount in rent, and that's called trade for services. So let's say your rent's normally 2,000. You've got a tenant who's like, hey, I'm going to redo your bathroom. I'm not paying rent this month. You actually still have to declare the value of their services as income, but then you can deduct it as you can use it as a deduction. So that's just something to be aware of. Again, will the IRS come after you and be like, oh, why didn't this person pay this month? Probably not, but it's just something to be aware of if you ever do get audited and the auditor looks at your monthly statements and says, oh, this person was paying rent of 2,000 and suddenly there's 2 months that they're not. What went on there? So you may have to explain it. The other thing is tenant paid expenses. You're out of town, the toilet overflows or there's an issue, the tenant has to call a plumber and they then pay for that. You then have to declare that's considered income, but then you can use it as a deduction. So it's, again, some things that people don't really think about that can affect your cash flow. Okay, home office deduction. This is, again, one of those gray areas, because if you manage rental properties, you may not be doing enough work to justify the home office deduction. But basically what you can do is you can look at a space in your home, and it's supposed to be a dedicated office. Like, it really shouldn't be the guest bedroom that you also use as the TV room and then you have your office. It should be a dedicated space, and you should show that I keep all my rental records here. It's in a locked closet. My computer I just use for this. I don't have a TV. So this is where it gets a little bit in the gray area. And also, what people don't realize with the home office deduction is when you go sell that house, the government does expect you to pay back the deduction. And so that's just something to be aware of, that it may not make sense for your business. But if you do this deduction, you can look at a percentage of your utilities. If you're renting, you can look at a percentage of your rent or your mortgage. So those are some extra deductions you can take. But even if you don't take the home office deduction, you can still deduct for your phone, your internet, the cost of office supplies and equipment. So you can look at, again, you need to, if you're using a cell phone, which we all are, you don't only use it for business, you also use it for personal. So you need to look at a percentage of personal versus business and make sure you're doing that appropriately. And so, if you're like, oh, I have a cell phone, I'm going to deduct the whole thing, that's, again, going to be a red flag, because you're probably also using it for personal. So home office deduction. Okay, so the pass-through tax deduction. So this was something that came about with the Tax Cuts and Job Act that Trump passed. And basically what it is it allows this pass-through deduction. So you can basically look at your net rental income. So let's say you make $100,000 income on your rentals. You can then deduct 20% of that rental income. So you can say if it's 100,000, you can take 20,000 and then you're only going to pay taxes on the 80,000. So there's limitations to this. And then you also have to prove that you are running a business and this is not an investment. So if you have one rental property and you have a property manager managing it, you probably cannot do the pass-through tax deduction, because you do need to show that it's a business. And showing a business, they have this thing called a safe harbor rule that says you are working on your rentals 250 hours in the year. And that could also include your lawn service person, somebody who goes and does repairs, your property manager. So those hours can all go into it. And then you also have to maintain accounting records for your properties as well. So, if you've got multiple properties, it's pretty easy to show that this is truly a business and not an investment. So this is kind of a nice tax benefit that came across. Again, not sure how much longer. It's right now in play until I think 2025. I doubt that it'll be renewed, but again, we just never know. But it's a nice one that you can take advantage of. Okay, and then I'm just going to talk about a couple tax tips. So we talked about if you have a contractor who is doing work on your property and they're doing $600 or more worth of work with anything related to your rental, then you do need to provide them with a 1099 miscellaneous form. So, I completely forgot to do this, and then I was like, oh, and so I sent mine probably in early February, but we've got somebody who takes care of the lawns at some of our rental properties and does aeration. And so, I sent them a 1099 form. If you had a plumber who came out, who did some plumbing work, they may require one. And so what you need to do is you need to get their taxpayer ID number from them, and then they'll give you that information, and then you can file it online electronically, and you can mail them a copy or you can email them a copy, and then a copy goes to the IRS. And especially if you're taking deductions, the IRS will look at this. Oh, you just deducted $700 for this plumber. Where's your 1099? And so just be aware that that's where a lot of landlords do get dinged on. The other one is just keeping track of your tax due date. Right now, there is a proposal to delay taxes from April 15th to June 15th. Last year we had taxes delayed as well because of the pandemic. And so there's kind of this movement to let's do it again this year, just because of some tax changes and people, getting checks from the government. So we're not sure that's going to happen. But if you think you cannot file that April 15th, then you can request an extension. And I actually know a lot of people who every year they just request an extension, because there is talk, especially with accountants, that if you request an extension, there's less chance that you will actually be audited by the IRS. So I know when we were using an accountant previously, every year we would just request an extension. And, we would pay by I think it was October 15th is when everything's due. So that's just something to think about. And then, tax tips, just make sure you're maximizing every tax deduction. Even if you have to pay taxes in the future, it's better for you to have that money today versus, waiting for the future to take that deduction. So, just making sure, whether you use TurboTax or you use an accountant, just making sure you stay organized and you look at every deduction. And then make sure you have a good file system. If you do get audited, if you have a really organized file system, whether you do it by year or you do it by rental property, you keep receipts, you keep track of your mileage, your whole process is going to go a lot smoother. So, whatever works for you, that's what you do. I know a lot of people might scan their receipts and then keep it online. And especially if you get like receipts from Home Depot that are I forget the material they use. It's like that waxy receipt material. that actually fades over time. And so even if you're keeping that, you know, in 2 years, you might look and be like, oh, it's a blank piece of paper. Make sure you are keeping good records with that and copying it. You know, we use a product called Money Dance. So anything, it's kind of like a, you know, a Quicken type software. So we keep track of all of our rental properties and what we spend in there. And then I also have a backup copy of the receipts that I keep in a file. So, and I don't know, Vanessa, if you've got any things, I mean, you use an accountant, but you've got to get all those receipts to your accountant. You know, if you've got any tips or tricks that you've done. You just muted yourself.
Oh, sorry. I just keep it all in an Excel spreadsheet per property. And then I just keep all the receipts. So I don't have to give my receipts to my tax person. It's already all organized in an Excel spreadsheet, which cuts down on what she has to do.
Yeah.
It's already done, but I know everybody has different methods.
Yeah. So that is pretty much, you know, we're just going to open it up to any questions that people may have.